the right stock at the right time.
Good morning. You're watching Daybreak on Bloomberg Quint Live, India's first digital live streaming business news service. I am Agam Vakil. Here are the headlines. Asian markets are off to a subdued start despite the biggest rebound since 2010 on Wall Street. Early indicators indicate that China's economy slowed for the 7th straight month as trade wars and subdued domestic demand took a toll. The rebound in oil prices continues after Russia signaled that OPEC and its partners may meet again to help the market. The government will inject capital in 6 of the 11 state-run banks that are under review, or rather under the Reserve Bank of India's prompt corrective action framework as part of its recapitalization plan. India's fiscal deficit widened further to 7.16 lakh crores. At the end of November, it had already surpassed the budgeted target for FY19 last month. And U.S. markets closed higher across the board on Thursday, prevailing over political uncertainty that left the markets fluttering throughout the day. And Taylor Briggs of Bloomberg News has all that transpired in the U.S. markets in this report.
Want to take a look at where the U.S. major averages closed today. It was an incredible day. Speaking of volatility, all the major indices were much lower this morning. The Dow was off as much as 500 points this morning, and somehow they all managed to close in the green. You had the Dow rising up more than 200 points to close up about 1.1%, staging a late day rally. The S&P 500 as well was up about 0.8%, and the story really does continue to be intact because tech was the big gainer yesterday when markets posed a big rally, but it did lag a little bit today. The Nasdaq was up just about 0.4% after trading in the negative for most of the day. Now, with most of the risk-off sentiment that we felt throughout the day, despite sort of a late-stage rally, you did see a bid for a lot of the safe haven assets. So you saw the VIX perhaps spiking up to about a 30 handle, and that was near the highs of what we'd seen during the lows of the market going back in February. You had gold, traditional safe haven asset, rise about 0.6%. And the yen strengthened relative to the dollar by about 0.4% as well. And you had the 10-year yield. It was rallying by as much as 5 basis points throughout the session. It closed lower by about 3 basis points altogether with a 277. At one point, that 10-year yield was having its biggest one-day move since May. So you did see a big bid for some of these traditionally safe haven assets. I want to take a look at some of the sectors that we were looking at. The S&P 500 consumer discretionary sector had a really good day yesterday, and it had a really bad day today on Thursday. As we mentioned, it was one of the worst performers, one of 4 that closed lower in today's session. It fell about 0.5%. And yesterday, of course, it had its biggest one-day move since March of 2009. So quite a big reversal here for the consumer discretionary index. There was a lot of concerns about the consumer. 10 a.m., the consumer confidence data came out. It was a little bit weaker than expected. And so there are some signs that perhaps the consumer discretionary index maybe perhaps got a little bit ahead of itself after that weak consumer data came out this morning. That index taking a little bit of a sigh of relief, closing down again today. That is a look at your U.S. markets here in New York.
And with that, let's go across to Rosalind Chin, who is with us live from Hong Kong to give us all the live market action. Good morning, Rosalind.
Good morning. Well, markets here in Asia looking pretty flat at the moment. Actually, the MXAP, the MSCI Asia Pacific Index, pretty much flat, up by just 0.05% at this time. Now, largely that's because of Japan, the topics and the Nikkei, both in negative territory here. The rest of Asia, though, is actually in the green at this point in time. So the Nikkei and the topics, we saw the topics falling after its biggest one-day rally in 2 years. We saw Japan factory output out earlier today. That saw the numbers falling in November. The SIC contract contraction in 8 months. We also had Tokyo inflation data, which is seen as an early indicator for the rest of the country, and that showed that price gains slow. So generally, not a particularly strong outlook there for Japan's economy. In South Korea, though, that actually is making gains. The cost be up by 0.6% right now, shrugging off some data earlier today of industrial production, which was a bit of a miss. However, we do see Samsung there leading gains, up by more than 1%. Here in China, well, the Hang Seng, the Shanghai Composite and the CSI 300 all making gains at this point in time. We do see, though, that overall, as we look back at 2018, the Chinese stock market wasn't the best. In fact, it was the worst stock market in 2018. Shanghai Composite around 25% below where it started the year. Trade war, of course, wiping out $2.3 trillion this year, and a deleveraging drive also in China, squeezing debt margins. We also had beige book information coming out showing that China's economy is continuing to deteriorate and risks heading for a much weaker 2019. State and private firms are borrowing, but that isn't stoking growth much, if at all. And overall, we see volatility is back if it ever went away at all. And that, of course, is probably the new normal. Volatility here to stay. Now, we're looking, of course, at the last trading day today for Japan, South Korea, Philippines and Thailand. Those markets will be closed on Monday. But on Monday, we do, of course, have China manufacturing and non-manufacturing PMI to look forward to, if you can call it that. Back to you.
Rosalind Chin, thank you so much for joining us and taking us through the Asian markets. But moving on, China and the United States have made plans for face-to-face consultations over trade in January as the world's two biggest economies advanced efforts to resolve a months-long trade war. Derek Wallbank of Bloomberg News tells us what to expect in this report.
There were nearly 1,000 exclusions that were put through today on everything from that to marine engines. This isn't like the thing, but this is one of those things that you say, right, this had to happen as we're going through if we're actually really going to have a thaw. So let's say that this was a step down the yellow brick road toward those trade talks that we're pointing toward. Certainly I think traders are looking for any signs of a thaw. This is one of those points that you sort of look at, you say, right, this came along, it hit. There's a bigger thing on the horizon about trade exclusions. When we talk about the 200 billion line, certainly there's a far vaster ocean to pluck from there. So we've got a lot more to look for here, but encouraging signs, a little bit of a post-Christmas present for everybody.
On to our Indian markets then, and from what we can expect as far as opening and perhaps the trading session is concerned. We have Darshan Mehta who's joining us to give us an idea on the same. Darshan, for now at least the Asian markets are looking to consolidate a little bit. Is that what we can expect in our own markets too?
Yeah, so basically US markets managed to rebound in trade yesterday, but Asia is not seeing all that of a traction. Nikkei is down 0.5%. The SGX Nifty is also up 20 points, but that can change till the time the market opens. So nothing much to talk about as far as the SGX Nifty is concerned. But for the past few days, we've seen that the second half of the day is where the rally actually happens on the Nifty itself. So we're close to the 10,800 mark in trade. ADRs ended negative. You had Vedanta and Tata Motors, which was down anywhere between 2%. ICICI, Dr. Reddy's also managing to stay down in trade. Apart from it, the counters that managed to gain was Infosys, Wipro and HDFC Bank. Now, if you're looking at what happened in trade yesterday, again, another 50-point up move as far as the Nifty is concerned. But again, the Nifty managed to outperform the broader indices. So the Nifty mid cap was up 0.3% and the small cap was up 2/3%. As far as the Nifty Bank is concerned, that was trading weak in trade. It was down by 100 points and the Nifty PSU banking index was down by another half a percentage point. So that was where weakness came in. FI is bought in 1,700 crores in the cash market. DI is sold in 663 crores in the cash market. Overall, if you're looking at the Nifty was up almost 50 points. What led to the rally? Again, Reliance and HDFC are the two counters which continue to contribute significantly. Surprisingly, HDFC, the banks were rather weak in trade. So HDFC Bank and Kotak were weak in trade. Maruti continued to bleed and IT as a sector did well in trade. So we were up 50 points. As far as the F&O markets are concerned, what we saw as far as the Nifty is concerned, the expiry happened. We are into the new series. As far as the Chan series is concerned, we are trading at a premium of 30 points. Open interest build up of 25% on the long side since the rollovers did manage to happen. As far as the Nifty Bank is concerned, again, open interest build up of 50%, that too on the short side. So the Nifty Bank was trading slightly weaker than what we saw the Nifty trade. Now, where are positions taken in the new series? 10,800 to high level is levels where call writers are active and put writers from 10,700 to lower level. So initially the stage sets between the 10,700 and 10,800 mark in trade. What happened in trade yesterday? Given the fact that the markets were a little wobbly in trade, call writers were active at 10,800 and 10,900, and they were shedding off open interest at lower levels. Now, if you're looking at the counters in the F&O band, Adani Power continues to remain in the F&O band. Let's take a look at the Nifty PCR, the Bank Nifty PCR. The Nifty PCR managed to move up to 1.54. The Bank Nifty PCR came down given the fact that the Nifty Bank was trading weak in trade. A couple of stocks that I want to highlight. First of all, PC Jewellers, look at the open interest build-up, and the counter was one of the top F&O gainers in trade, was up almost 5% in trade. Coal India, surprisingly from the Nifty pack, was doing well in trade, moved up 1.5%, but the open interest build-up was rather strong in trade, which trades at a discount of 10 points. JSPL, again, fresh short positions were seen on the counter, open interest build-up of 27%. And finally, the last one we saw was 64% open interest build-up in Ajanta Pharma. The counter managed to rally almost 4% in trade.
Darshan, thank you so much for bringing us those details. We'll be watching out for how things pan out in our Indian markets on the final trading day of this week. But emerging market equities may be the chosen one for investors across the globe. But that does not mean that returns will meet expectations, says Mark Matthews, the head of research at Julius Baer, and says that the recent sell-off in the U.S. just complicates matters further.
If you look at the most crowded trades going into every year, they usually don't end up being the right ones. So all I will tell you is that from what I can see, the most crowded trade going into 2019 is long emerging market equity. And this position has been building for the last few months, and it makes sense on the surface. I mean, they had a terrible year last year. Their currencies got walloped. How much worse can it get in places like Turkey or Argentina? So I can certainly see the merit in certain aspects of emerging markets, primarily their fixed income. But I think that it's dangerous to assume that they are going to turn the corner, number one, if the Chinese let their currency go. Number two, I still think for all its faults, the dollar is the default currency of the world, and I think it would be wrong to be very bearish on the dollar. And number three, now we've had this huge sell-off in the U.S. If the numbers are right, the U.S. is trading on around 15 times next year's earnings. It's actually not an expensive market anymore. So all of those things make me think that this big emerging market trade is going to turn out, I'm not saying it's going to be a disaster, but probably less good than anticipated.
Let's shift focus to commodities then, and we have Yash Upadhyay as usual, who's joining us to give us updates in those markets. Yash, good morning.
Morning, Agam. So crude oil prices, they continue to trend lower, with the Brent falling more than 4% on Thursday over lingering concerns of a supply glut and slowdown in economic growth. Now, this comes on the back of Russian energy minister telling reporters in Moscow that it may ramp up production in the second half of 2019, even under the current OPEC agreement to cut output. Meanwhile, crude oil prices, they came under further pressure following an industry report suggesting a surprise increase in U.S. crude inventories. Mixed news coming in from the base metal space. Aluminum prices, they fell over 2% on Thursday, falling for a fourth consecutive trading session, followed by nickel, which fell for another 1%. Copper and zinc prices, they snapped their respective 3-day losing streak, and lead prices, they gained more than 2% to hit a near 2-month high. On the other hand, spot gold prices, we continue to see strength coming in there, with gold prices trading near the 6-month high as prices increased for a second consecutive week amid financial market volatility, political turmoil, and concerns that global growth is slowing down.
Yash, thank you for joining us and getting us those details. But the government will infuse capital in 6 state-run banks under prompt corrective action. And the latest round is aimed at lenders that face restrictions because of weak financial and operational metrics. Vishwanath Nair here joins us to give us more on the details.
The government has initiated the process of infusing additional capital in public sector banks, as it had promised a few days ago. At least 6 public sector banks are set to receive additional capital, according to what bankers are telling us. Of these 6, Bank of India is set to receive about 10,000 crore, which is the highest amount among all of these banks. So subsequently, UCO Bank will receive about 3,000 odd crore. Bank of Maharashtra will receive about 4,500 crore, while United Bank informed stock exchanges that it is set to receive about 2,160 crore. Now remember that all of these funds will help these banks meet the minimum capital requirement as is stipulated under Basel III guidelines which the Reserve Bank of India had implemented in the banking system. However, all of these banks are under the prompt corrective action framework of the Reserve Bank of India and are facing considerable lending restrictions, which does not allow them to expand their corporate book beyond a certain limit. Now, while this money will not help them come out of the PCA framework, it will certainly help them enter the new financial year with a stronger footing, because once the capital part of it is taken care of, then the banks can focus on improving the profitability by reducing the level of bad loans on their books. Now, the government had a few days ago sought permission from the parliament to infuse about an additional amount of 41,000 crore into public sector banks. This amount of 41,000 crore is in excess of the 2 lakh odd crore worth of recapitalization plan that the government had announced back in October 2017. Much of this entire amount, about 2.5 lakh crore, will be in the form of recapitalization bonds. Especially this additional 41,000 crore is entirely in the form of recapitalization bonds, because of which the government contends that it is going to be fiscal neutral, since there is no amount being transferred from the government accounts to these public sector banks. However, experts point out that the government will have to pay interest on all of these bonds to the banks that are receiving them, and therefore that will impact its fiscal status.
And moving on, Nikki Mirchandani now joins us with the stocks in news. Nikki, what do you have for us list? Good morning.
Good morning, Agam. Not too many on the list except for a few banks that Vishwanath spoke about that is expected to be in focus. I'm going to start off with Lemon Tree, where the Warburg Pincus has inked a 3,000 crore JV with Lemon Tree to offer co-living space. That's the first time that the joint venture, the company is entering into a rental housing accommodation space. So this is one counter that we like to keep an eye out. Kansai Nerolac, which has entered into a share purchase act with Perma Construction, aids for a sum of around 30 odd crore. Relatively a small number, but then the acquisition is expected to be completed next year, Jan 28. And last on the list, we have WAPCO India clarification, which said that it's the parent company which has signed in a $950 million supply pact with commercial vehicle maker, and it's not the company which has actually signed the contract.
Nikki, thanks for joining us and getting us those stocks which will be in focus on the back of news. But moving on to Somit Sarkar, who's standing by with the big brokerage calls of the day. Good morning, Somit.
Good morning, Agam. Now, the big brokerage calls for the day first we have is MK on Ashok Leyland. Now, the brokerage has downgraded the rating on Ashok Leyland to hold from buy and has cut the target price to 113 from 152. Now, according to the company's according to the brokerage channel check, a reversal has been seen in the MHCV sales cycle, driven by surplus capacity, increasing cost of ownership, and selective financing by NBFCs, and because of a high base. Now, along with this, the product mix has also turned adverse due to implementation of this new axle load norms, as customers have now shifted on lower tonnage trucks. Now, in the CV space, Ashok Leyland has also lost market share as the competitive intensity has increased due to subdued volumes and aggressive marketing strategies by Tata Motors. Lastly, the brokerage expects pre-buying due to implementation of PS6 norms to support volume growth in FY20, but for FY21 it is expecting the volume growth to be negative when it comes to Ashok Leyland. Second, the note that we have is on two-wheelers from MK. And according to the brokerage, the subdued festive season is now behind, and going forward it is expecting the two-wheeler volumes to recover gradually. But it is expecting 11% volume growth for FY20, and for FY21 it is expecting a volume growth of around 5% when it comes to the two-wheeler segment. Now, for Eicher Motors, they have upgraded the rating to buy from accumulate and have hiked the target price to 27,700 from 25,700. For Hero Motor, they have downgraded the stock to hold from buy and have cut the target price to 3350 from 3560 due to market share losses, lower volumes, and lower margin expectations from brokerage. Now, for TVS, they have maintained their accumulate rating with a target price of around and have hiked the target price marginally to 595. For Bajaj Auto, they have maintained their accumulate rating and have hiked the target price to 2910. Lastly, it says that new product launches remain the focus area for OEMs, as it will not only support the replacement demand but also market share gains for two-wheelers going forward.
Sumit, thanks for joining us and getting us that list of all the stocks which will be on the focus on the back of brokerages. But as 2018 comes to an end, let's take a look ahead on what kind of trends we can expect in the new year. David Inglis of Bloomberg News spoke to Ajay Sundar of Frost & Sullivan to discuss the key trends expected in the e-commerce space in 2019. Here's a slice of that conversation. Listen in.
If you look at consumer, I think one of the big broad trends we are seeing is definitely the rise of e-commerce. And again, we saw various regulators now getting more active, as we just saw in India. Beyond that, I think from a consumer standpoint, we are seeing Southeast Asia itself growing at a very rapid pace, right? Last year, we saw more than 37% growth just on the gross merchandise volume, which is the actual products which are bought over different e-commerce platforms. And we expect this to continue. And one of the other emerging trends because of e-commerce is the retail omni-channel convergence. So what's happening also is that the traditional retailers who were struggling with the e-commerce growth now are also realizing that they need to use or leverage e-commerce a lot more effectively. And we are seeing traditional mom and pop retailers now getting to e-commerce in a big way. And there's a new trend emerging where we're calling omni-channel commerce, where the traditional retailers are trying to figure out what's the new e-commerce mean for them. But again, riding on from e-commerce, one of the other consumer trend which we see is the rise of the sharing economy. Again, I think we had the likes of Airbnb, Ubers, Grab starting off, but that is spilling over and we are seeing a lot more sharing economy platforms being used. And that is also leading to another trend which is around integrated payment platforms using all these different sharing economy. So we are seeing different kind of payment companies, again, Alipay getting very aggressive, Grab starting its own wallet. And that payment itself will be a big force to reckon with in APAC when we look at 2019.
So Ajay, based on everything that you mentioned there, does it seem like this is simply a big boy playground, or should I expect a up-and-coming company in any of these major trends to make headway next year, or is it just the same names with the deep pockets?
Yeah. So again, I think consolidation will be a big, again, if you look at e-commerce, there is a big challenge in the sense of profitability. E-commerce is turning out to be the way the current business models are stacked, it's turning out to be a big boys game, as you rightly said. So the higher the volumes, the bigger the profitability. And again, that's one of the trends which we expect is many of the smaller e-commerce companies might fold up or consolidate with the bigger names here in the region, at least in APAC. We are expecting that trend. Right? But at least profitability is becoming important. And that's where I think most of the e-commerce companies are now taking a relook at their model. What kind of model works for us? Again, there's no point in burning money just to stay relevant or just to increase the top line. But what kind of new niches should we target? And that's where you see luxury e-commerce, for example, one of the segments which is coming up big in APAC, which relatively is much more profitable than the traditional e-commerce. Right? So you'll see that. You'll see again a lot of big boys consolidating or acquiring the smaller players, and a lot of smaller players who are struggling, folding up at least in the e-commerce space. We're expecting that for sure.
There is lots to talk about over the course of the day, and you will find all the live market action on Bloomberg Quint. There are also a few stories that you should consider reading on the website bloombergquint.com. Here they are. India's fiscal deficit continued to widen in November after breaching the budgeted target for the financial year 2018-19 last month. Second time in less than 1 year, the contentious Triple Talaq bill criminalizing instant divorce by Muslim men was passed by the Lok Sabha after a heated debate on Thursday. China's economy slowed for the 7th straight month in December as the trade war subdued domestic demand and decelerating factory inflation combined to undercut. And growth Michelle Obama, who's touring the U.S. to promote her autobiography, was named the most admired woman by Americans in a Gallup poll. It's the first time in 17 years that the former First Lady Hillary Clinton didn't top the list. The U.S. explorer Colin O'Brady became the first person to cross Antarctica solo, unaided and unsupported. Let's take a look at how he managed to achieve such a feat. With that, it's a wrap on this edition of Daybreak, but all you need to know is up next. Stay tuned to Bloomberg Quint.